Alrighty, well, I have about a minute after, so we'll go ahead and get started. Thanks for joining us this evening. We're back to our fall webinar series, and tonight we're going to talk about tax hikes on the horizon. I'm sure you've been hearing a lot about this topic. I know we've been getting a lot of questions about it, which is one of the reasons that we are doing this presentation. So I'm Jim Allen. I'm one of the presenters, along with Blake Pinion tonight, and I'll introduce him a little bit more in a second. But before we get started, could maybe someone just raise their hand to let us know that you can hear us okay and see the screen? Perfect. All right. Sounds like we're good to go. So let's get into it. All right. So I'm Jim Allen. I think I know many of you who are attending, but if I don't, I'm the president, I'm the lead financial planner, and I'm a firm principal at Anchor Bay Capital. In my professional background, I'm a certified financial planner as well as a chartered financial consultant. I have a master's degree in financial planning, and more pertinent to this particular presentation, I'm an enrolled agent admitted to practice before the IRS. So if you're not familiar with an enrolled agent, it is a credential that is issued by the Internal Revenue Service directly, and it is specifically related to the practice of taxes. Joining us this evening is my associate advisor, Blake Pinion. Blake is a certified financial planner as well as a licensed tax preparer. So Blake works with many of you on your financial planning, as well as probably prepared many of your tax returns this last tax season today too. So a little housekeeping before we get started. We are recording this presentation. So if you have to miss part of it or you want to go back and listen to it again, it'll be on our website in just a couple days. Or if you have someone you think that would benefit from the presentation, feel free to have them go to our website to view the presentation. At the end of the presentation, we'll open it up to any questions you may have about any of the stuff we're talking about or anything you felt like you wanted to ask. So you can just enter your questions into the chat box, and we'll address all of those at the end. Obviously, if what you want to talk about is more detailed than you could do in a Q&A, then certainly feel free to reach out to either myself or Blake, and we'll be happy to set up a consultation with you and talk about your individual situation. Finally, at the end of the presentation, you will receive a survey about the presentation. We'd love to hear feedback on whether you thought the topic was worthwhile. We'd also love to hear feedback on maybe other topics you'd like to see us present on. Our next one will be, I believe it's September 15th. Correct, Blake? Yep, okay.
Yes,
so
that's correct.
That one will be on Social Security planning. So it will be a webinar version of our Social Security planning seminar that we typically do at community centers all over the Southern California. So let's just jump right into it then and get started here. So if you've attended any of our other tax webinars or our seminar, you know that at Anchor Bay, this is kind of our motto. It's what you keep that counts, not what you make. And so we focus pretty heavily as part of your financial plan on the tax planning aspect because maybe we'll get you a better investment return. Maybe we won't. That's certainly not guaranteed. Those are the investment realm. A lot of it is opinion and speculation. When it comes to taxes, those are facts. We know what the tax code says. We know what we can and can't do. We can put a number on that. And so many times we probably can add more value through our tax planning than we can our investment management. And obviously we have great investment management. We've been doing that for 30 plus years, but we feel we really can add value to your financial situation through tax planning. And if you've attended our other presentations, you've seen this slide before too. So, how many of you raise your hands if you think taxes are going to go up in the next year or so? Okay, quite a few. How many of you think the taxes are going to go down? Not too many. Okay, and then obviously in between is are they going to stay the same? So that's kind of what we're going to talk about. Is you've probably heard a lot about tax rates going up. and potentially very dramatically. So that's what we want to talk about. We want to kind of just give you what the real story is about what's sitting out there, the likelihood of it becoming tax law, how it will impact your tax situation. And if any of this stuff does become law, we'll talk about planning opportunities that you can that we can do with you to cut your tax laws. I don't know if tax rates are going to go up or down or stay the same, but what I do know, having done this for more than 30 years, is tax rates change just about every 4 to 5 years. So it's a given that they're going to change. And what I've seen over the past decade is that rate of change is accelerating. Pretty much anymore, every time there's a change in Congress or there's a change at the presidency level, we have a tax law change. And then COVID certainly accelerated that because we had multiple tax law changes over the past couple of years due to the COVID pandemic. So let me just kind of show you a history of taxes. So, we look at the 50s through the mid 80s, so into the Reagan years, you can see we've had tax rates as high as 92%. And you can see throughout much of the 50s and into the 60s, it hovered in the, 80 to 90 to 70% tax range. And then finally with the tax law changes in 86, we finally saw a drop in tax rates. So, we're currently nowhere near the top tax brackets that we've been in over the last, 60, 70 years. You can see right now, the top tax rate is 37%. That was a result of the Tax and Jobs Act that happened at the end of 2017. As I'll talk about, that is going to sunset, and we very well could go back to the previous top rate, which was 39.6%. And a lot of things that President Biden has proposed at this point tie back to that previous top tax bracket. So, you can see that tax rates have been all over the place. And, and if we're looking at you from a perspective of retirement, we talk about this all the time when we're working with you is, your tax rates are probably going to change another, 4 or 5 times or more during your retirement. And so, kind of the old adage that when you retire, your tax rates will go down. Not necessarily so. The combination of constantly changing rates in addition to, most people sticking all their money into tax deferred accounts creates a situation you very well could be paying a heavy burden in taxes during retirement. And that's one of the things we definitely want to plan against. So let's talk about some of the recent changes. I mentioned there's just been a ton of them over the last 5 years. So we start with the TCJA, the Tax Cuts and Jobs Act of 2017. So those are the Trump tax cuts. And there was a bunch of changes that were involved there. Changes to the rates. You saw in that previous chart that the top rate went from 39.6 down to 37. Changes to the standard deduction. So the standard deduction was doubled, whether you were single or married, essentially. And what that did is it eliminated the use of the itemized deductions or the Schedule A for the vast majority of taxpayers. The big one, I think, that's impacted a lot of people we do returns for, and a lot of people in California and other high tax states, is the dreaded SALT cap. SALT is state and local taxes. So this is the one where the maximum you can deduct for your property tax, your state income tax, your vehicle registration fees, all of that stuff's capped at $10,000. And if you paid $100,000 of state income tax, you only get to deduct $10,000. And that one has definitely hurt a lot of people. And so there's rumblings that they may do away with that, and we'll talk about that. But at the moment, we still have the dreaded SALT cap. And then finally, the other biggie that came out of the TCJA was the reduction in corporate rates from 28 down to 21. So that was a big boon for corporations. People started repatriating their corporate funds from offshore, and so it helped invigorate the economy. So that's TCJA. That's a big one, and as we'll talk about, it's going to sunset at the end of 2025, so it's going to go away altogether, absent changes or an extension, and we'll see. The other big one, and Blake will talk in more detail about what came out of this one, is the Secure Act. That was done in 2019. It had some negative provisions around what we call the stretch IRA. It had some positive provisions around changing the retirement age. So there was kind of a mixed bag in the Secure Act. Those are all laws, and we're going to talk about Secure Act 2.0, which is on the horizon in a minute. And then we get into all of the COVID stuff. So the first one we had was the CARES Act, which suspended required distributions for 2020. You had the tax credit and rebate checks. You had COVID distributions from IRAs. Suspension of student loans. You had a whole potpourri of things in there to keep people from really suffering under the economic shutdown due to COVID. Then as a follow-up, we had the Appropriations Act, which provided the second stimulus check. And then finally, this year in March, we had the American Rescue Plan, which provided an additional stimulus check in addition to some other goodies that Blake will talk about. So just in the last 2 years, we've had 4 different tax changes. That's a lot for a 10-year period, let alone a 2-year period. So that's stuff that's already happened. Those are laws that are in effect. So let's talk about what may happen, because I think that's why most of you are attending this webinar, because you've heard that there's a lot of bad stuff on the horizon. And so we're going to go into detail on all of those. So the TCJA, as I mentioned, is set to sunset on the end of 2015. So 2025, not 2015. So the way that was set up, and this is a kind of a function of the rulemaking, is that if there's not enough votes, they can enact things like this, but they sunset. And so in this case, all of the stuff that's in the TCJA, the increase in the standard deduction, the increase in the estate tax exemption, the SALT cap, all the stuff positive and negative, is going to end by the end of 2025. So we've got another 3 or 4.5 years to go on this, but we're going to see some changes. Obviously, there could be tax law changes in between that extend the TCJA or sunset parts of it or scrap it altogether. We'll have to see. But we know that by the end of 2025, again, a little over 4 years from now, that we're going to have another tax law change. So that's right on that 4 to 5 year schedule. As I mentioned before, tax law changes has accelerated dramatically. It's the Republicans will take power, they'll put in a bunch of changes, and the minute they're no longer in power, the Democrats come in and make their changes, and it just seems to be back and forth. It really creates a lot of instability in terms of trying to plan from a tax and financial planning standpoint, because the rules are constantly changing. And I think what's really important, that we want to stress here is that Congress controls the tax legislation. So whether it was President Trump or it's President Biden, they can propose things and ask for things, but they can't get any law done. It has to be done through Congress. Right now, the Democrats have marginal control, so they can get some things done on their own. Some things that they want to have more permanent or whatever, they have to get bipartisan support. Kind of going back to the way the TCJA was enacted. But the Democrats have marginal control. And so they're trying to push things through that they want to get accomplished, why they still have that control, because that very well could change in the elections of 2022. Okay, so how are tax laws created? As I mentioned, it's Congress that implements new laws. And so what happens is someone in Congress, it could be in the Senate or it could be in the House, they introduce a tax bill. And for example, the Secure Act and the Secure Act 2.0, those were introduced in Congress. The House and Senate both have to pass it. A lot of times they'll have differing versions of it. And so what will happen is if they both have their version of the bill, they can do something called reconciliation and kind of combine the bills. And that's a lot of times what happens. So they'll combine those bills, kind of come up with the best of both worlds, or in some cases it's the worst of both worlds. Then it goes to the president. The president either signs it or vetoes it. And if they sign it, and then the bill becomes law. and now we have a new TCJA, or we have a new Secure Act. So, you know, you hear all this stuff, and we're going to talk about all these tax laws that are floating out there. Just remember that nothing's a done deal unless Congress agrees that it's a done deal and the president agrees and it gets signed into law. So that's a long process, and with kind of the divided government we have right now, very difficult to get stuff done. And so, you know, the proposals we're going to talk about, for the most part, you know, they may happen, they may not. You know, they may be altered. The way I look at it is I kind of categorize them as to, is passage of the bill likely? Is passage of the bill probable? Is the passage of the bill possible, or is it unlikely? And we'll kind of break down each of these potential law changes into those categories for you. You know, so, you know, one of the main reasons we are doing this webinar tonight is because we've gotten a lot of questions from people that have been scared. You know, they read stuff on the internet, or they watch the financial news, or they listen to, you know, the talking heads, and you hear that, oh, tax rates are going to go up, and, you know, your financial plan is going to be devastated. You know, all this information is confusing, and, you know, when you're on the internet, or you're watching, you know, the financial news or whatever, you know that doom and gloom sells. They're going to talk about stuff that's going to catch your attention. So if they tell you, you know, now you're going to have to pay an estate tax and the tax rates are going to go up and all that, they're doing that to catch your attention. I mean, I essentially call it financial porn. And the same goes for investment stuff. You know, every day they're talking about this stock or that stock or Bitcoin or whatever. You know, they don't know your individual situation. You know, they have no idea whether, you know, your income level is such that these will impact you or not impact you. They don't know whether they're going to be a done deal or not. So, you know, just take all of that with a grain of salt. And if you do have concerns or questions, obviously that's what we're here for, is to help you out and give you advice on these things. And that's really the primary purpose of the presentation tonight, is to just kind of talk about, this is what's out on the horizon. This is what may happen. This is what probably won't happen. And hopefully allay some of your fears and answer any questions you have. And kind of give you, you know, the straight talk on what's actually going to happen. So, you know, the big one you probably heard about is President Biden's American Families Plan. We're going to talk about that next. So, you know, is the hype real? Well, there's three outcomes, as we talked about. The bill makes it through the Congress and the president signs it. The bill dies in Congress, and this happens a lot, probably more than any of these others. And even if it dies in Congress, they get, you know, reinstituted every year or so. And so the Secure Act, for example, it was introduced into Congress multiple times before it got passed. Secure Act 2.0 has been introduced a couple times. It's back in Congress. A lot of times what happens is the bill gets modified and then passed. One of the prime examples of that is the infrastructure bill that's, you know, currently on the verge of making it out of the Senate. It's being modified right now. And then, it will likely be passed, but does the current form make it all the way? Who knows? More than likely, it probably won't. So let's talk about the tax proposals that are floating around out there. As I mentioned, the big one, the one that you probably heard about the most and gotten the most attention, is President Biden's American Families Plan. We'll talk about all the provisions of that. The first thing to know about that is, at this point, it's merely a proposal. It's not even introduced in Congress. This is just what President Biden would like to accomplish. And each year, the presidents have their budget, or what they call their green book. And in that, they list all the things they would like to do and get accomplished. And so that's kind of what the American Families Plan is. And so at this point, you know, it's pure speculation as to what that will end up looking like. But we'll talk about the provisions you've heard about. The second one is the American Jobs Plan, or the infrastructure bill. That's the one that's currently being kind of hashed out in the Senate. And it doesn't really have any impact on your personal financial situation, when it comes to taxes. Any of the stuff that's in that bill were primarily related to corporate taxes. And so they were talking about raising the corporate tax rate back up to what it was at 28%. They were talking about having a minimum corporate tax rate of 15% for large corporations. they were talking about increased IRS enforcement on corporations. That one's already been kind of struck down and is out of the bill. So those are the two big ones from President Biden. Next, you have the Secure Act 2.0, and we'll talk in more detail about that one. There's also been floated changes to the SALT cap, and there's a bunch of different versions of that, so we'll talk about that. And then finally, in Congress, in the Senate, there's been proposed changes to the donor advised fund rules. So this one doesn't impact a large amount of people, but it's one of those things that potentially could get passed. And if you're charitably inclined and you're making charitable gifts, this may be one we'd want to look at doing sooner rather than later. So let's start with the American Families Plan. I put this in the possibility category. As I mentioned, it's just in its infancy. It's just getting started. It's not even in Congress yet. Right now, they're working on the infrastructure bill. Then we'll see, when this shows up. And so this is kind of the big bad one that you've heard about. So the first thing to know is they've proposed taking the 37% current TCJA top income rate back to 39.6. And where that would happen for a joint filer is just a little over $500,000 of income. So if you're married filing jointly and your income's over 500, you would go from 37 to 39.6. That one's not going to impact that many people. The next one is the biggie, and probably the one you've heard of, is no capital gains rates. No capital gains rate over $1 million of income. So this is the way this would work. Right now, when you have a capital gain, then you get favorable rates. There's a 0% capital gains rate. There's a 15% capital gains rate. There's a 20% capital gains rate on most assets. There's also a couple other categories. But, if you think about your stocks, your real estate, your business, things like that, you get favorable capital gains rates when you sell them. What this would do is if your income is over $1 million, then you lose the favorable capital gains rate and you would be taxed at ordinary income, which under this law would be back at 39.6%. So that applies to capital gains, the sale of a property for a gain. It also applies to qualified dividends. So if you have a stock, say Apple, that pays a dividend, generally those dividends are qualified dividends, and they qualify for that preferential 15 or 20% or 0% capital gains rate. So we want to have capital gains because it's just taxed at a better rate. Now, unfortunately, in California, we don't have a capital gains rate. So this doesn't impact your state tax in California at all. This is strictly a federal thing. And the way this is worded, it's not if your capital gains is more than $1 million, it's if your income is more than $1 million. So if you're a situation where maybe you have $300,000 of wages and other income, and you sell a property for $750,000, now you're thrown into this ordinary income rate. So this one would be pretty substantial and significant. The other thing you may have heard is there had been talk that this would be made retroactive to the beginning of the year, which would eliminate planning. While that is perfectly legal, and that has happened in the past with various tax laws, not likely to happen, particularly since we're already in August and it's not even remotely close to becoming law. So I don't think you have to worry about retroactivity. Frankly, I don't even know if this is going to get done this year. This very well could be something we'd have to look at in 2022, but I'm not sure that it's going to get done for 2021 because they've got other things that they're trying to do first. The next one, and this one would definitely impact a lot more people, would be a change to stepped up cost basis. So if you're not familiar with stepped up cost basis with your home or your business or your stocks, when you pass away, the value from a capital gain standpoint gets stepped up to the value on the date of your death. So let's say you have a home that's worth $500,000 and you pay $200,000 for it, you've got a $300,000 capital gain. So if you sold it while alive, you would incur the $300,000 capital gain. If you hold on to that home until you pass away, the value from a capital gain standpoint now gets increased to that $500,000. and your heirs could sell it the next day for 501,000, and they'd only have a capital gains on $1,000. So that's a big deal. When we're doing tax planning, we look at this, very closely. If you have a portfolio of mutual funds, say, that have got a ton of appreciation in them, and you're in your 90s, we probably don't want to sell those unless we have to, because we can just hold off until death, and that gain would go away. So what the current proposal is in the American Families Plan is essentially they're eliminating the stepped up cost basis on a lot of assets. And what would happen is when you pass away, or if you give away the asset while alive, that triggers the gain recognition. So that example where we have a $500,000 house that you paid $200,000 for, under this law, when you passed away, the gain doesn't go away like it would with a stepped up cost basis. Your estate would incur a $300,000 gain, and the tax would be paid at the time of death. Or to try and get around it, you give away the asset, you would incur the $300,000 gain when you gave the asset away. So Canada has a similar system, and so this is kind of like the Canadian system. Now the good news is, in the proposed law, they've given you for a single person, $1 million exclusion. For a married couple, it's a $2 million exclusion. So, it may not impact you, but obviously this was one that would be pretty costly to a lot of people if this gets initiated. So you'd have recognition at either sale, at death, or gift, instead of the stepped up cost basis. Next is a limit on 1031 exchanges. So if you're not familiar with 1031 exchanges, you own a piece of real estate, it has a bunch of gain in it, you'd like to sell it, and if you do, you incur that gain, but there is a provision where you can exchange it for another piece of real estate, and you can essentially defer the gain until you dispose of the next piece of real estate. It's called a 1031 exchange. Right now, as long as it's a like kind and it's real estate, you can do these 1031 exchanges. This bill would limit the maximum 1031 exchange to $500,000. So obviously this would cut into a lot of rental property planning, things like that. And then finally, the last one on here is you have something called the ObamaCare or NII tax. It's a 3.8% additional tax on essentially unearned income. So your interest, your dividends, your capital gains, all of that kind of stuff, you have to pay the 3.8% Obamacare tax if your income exceeds $200,000 single, 250 married. So what this proposal is talking about is if you have a business that's an S corp or an LLC or a partnership, etc., they're going to apply that 3.8% additional tax to those kind of businesses at the $400,000 income level. So if you own one of these pass-through businesses and you have a good income, you're essentially seeing a 3.8% increase in your taxes. So there is some bad stuff in here that you need to be aware of. President Biden had claimed while he was, running for election that he wouldn't, impact people that made, less than 400,000. He's kind of stuck to this. The issue is, obviously, it's Congress that makes the rules. And so whatever he proposes could certainly get changed by Congress. And some of these thresholds could be lowered. Obviously, some of them may see reluctance on the part of the Republicans, in particular the stepped up cost basis issue, and so those thresholds could get raised or eliminated. But this is what's sitting in the Americans Family Plan at the moment. Is it possible that it's going to get enacted? Yes, it's a possibility. Some of these will be maybe eliminated. Some of the thresholds may be changed, but there's a possibility that this could happen. I don't think there's a high possibility that it will happen this year. It'll probably get put on the table for next year. But there is an urgency for the Democrats to get something done while they still control Congress and the presidency. Now, what isn't in the plan, and these are some of the things, again, you probably heard about on the internet or in the press, is that they're going to make changes to the estate tax. That is not in the bill. That is in President Biden's Green Book proposal, meaning that's something he'd like to do, but he didn't put it in the bill. So right now, because of the Tax Cut and Jobs Act, each person has a $11,700,000 exemption against the estate or gift tax. It's indexed for inflation, so it keeps going up. So if you're a married couple, unless you're worth more than $23,400,000, you don't have to worry about the estate tax. A single individual, as long as you're worth less than $11,700,000, you don't have to worry about the estate tax. Now, this will sunset at the end of 2025 because it's part of the Tax Cuts and Jobs Act. So what happens if it sunsets? It goes back to what it was before, which was a $5.5 million per person exemption index for inflation. So in 2025, it very well could be you would have a $6 million plus exemption. So a married couple, we'd be looking at $12 million. So right now, 99.99% of the population doesn't need to worry about the estate tax. If this sunsets or it somehow becomes law in the next few years, then 99% of the population doesn't have to worry about the estate tax. So again, this is something you've heard about. You don't need to do any additional estate tax planning at this point. Even if this were included in the American Families Plan, you probably still wouldn't have to worry about it. Now, if you live in a state that has a state inheritance tax, for example, Washington, Connecticut, New York, New Jersey, some of these others, you still have to plan around that because a lot of these states didn't give you an $11,700,000 exemption. It may be $2 million, $2.5 million, $3 million, whatever. So we still may have to do some estate tax planning at the state level, even if you're well below the current exemption for the estate tax. And as I mentioned, under the American Families Plan, what President Biden proposed is really no changes for incomes below 400. So far, he's been true to that. Again, it very well likely could change in the future, but at the moment, everything is geared towards high wage earners. And so we'll keep you posted on what happens with all of these down the road. And if some of these become law, certainly we would start looking to plan around them. So let's just say this actually does happen. The American Family Plan happens. So if it happened this year, what we'd probably be looking at, because it would become effective 2022, it's not going to become effective retroactively this year, then there may be situations where, if you're looking at a 43.4%, capital gains hit next year versus a 23.8% this year, maybe we'd want to accelerate, the sale of some assets. For example, right now we're working on a situation where a business is going to be sold. The business is worth in excess of $4 million. Very little cost basis. So, if this becomes, looking like it's going to happen effective January of 2022, we may want to sell that business this year, even though the person's still working and would have, higher wages. Just $1 million capital gains. The difference between this year and next year would be almost $200,000 of additional tax. So there definitely could be incentives to accelerate the sale of whether it's a business, whether it's a real estate holding, whether it's a large block of stock. We would look at, do we want to accelerate that? And, when we add in your current your taxable income to what you would be looking at next year, is it beneficial to accelerate that or not accelerate that? So it'd be something to evaluate and see whether it would make sense to do that or not. Other things we'd be looking at, let's say the stepped up basis change became law. So again, if we're looking at, you've got a highly appreciated asset. You bought Apple stock for $10 and, now it's worth several $100. And now if when you pass away, it's not going to get that stepped up cost basis and your state's going to have to pay the income tax. Well, you've got this huge gift tax exemption. As I mentioned, you can use that $11,700,000 exemption while alive, or at death, or a combination of the two. So maybe we would look at, if you don't need all of these assets, we would give away the highly appreciated assets now and at least defer the triggering of the tax until down the road when your heirs, sold it or whatever. And we'd keep your lower appreciated assets, so when you passed away, there's less of an income tax hit. And we could do that because you don't have to pay any gift tax as long as you're below that $11,700,000 or $23,400,000 threshold. The other thing we'd look at doing is, if you're thinking about you're selling your home, this might be another one we want to accelerate. And we use the $250,000 or $500,000 capital gains exclusion against selling a home, sell the house, avoid the current appreciation, buy a new house, and start with a higher cost basis on the new home. So there are some things we can do, and if this is going to impact your individual situation, we'd certainly want to talk about, should we be doing some of these things, and does it make sense? And we're going to have to run projections for what to look like income-wise this year versus next year, all of that kind of stuff. But there are some planning things that we can do if this tax bill becomes law. Okay, so let's talk about the change to the SALT cap. This is the one that I wish would happen, but it's pretty much in the unlikely category because there's not a lot of bipartisan support for it. And, there's, it's just sitting out there at the moment. It's been kind of kicked around by a few Congress people, but there's nothing currently in legislation. So what they've talked about is eliminating the cap altogether, and going back to the old rules where if you had $100,000 of state income tax, you got to deduct all $100,000 instead of $10,000. They've talked about changing the $10,000 cap to a $20,000 cap for a married filer. I mean, that's one of the unfortunate things, that $10,000's the same whether you're single or married. And so they would change it to a $20,000 cap for married filers. They've talked about increasing it to some other level, $15,000, $25,000, something like that. So we will keep you posted on where this one goes, because this one definitely impacts a lot of people, particularly in California because of our high state income tax. At the moment, it's just on the radar. You may have heard that this was going to happen. At this point, I would say it's unlikely it's going to happen. It's not included in any of the current legislation, and no one's really on the horizon planning to introduce this to Congress this year. Okay. The last new bill that I want to talk about is the Accelerating Charitable Efforts Act. Essentially, this one puts limitations on donor advised funds. And if you're not familiar with donor advised funds, the way this works is it's a tool to allow you to kind of front load a bunch of charitable deductions. So rather than you giving, $10,000 a year to the United Way for 10 years, you could contribute $100,000 in 1 year to your donor advised fund, assuming you could take the entire deduction. You'd get a $100,000 deduction in 1 year. And then through your donor advised fund, you can make grants out of that to the United Way or whatever charities you want. So it's a great tool to front load a bunch of charitable giving. If we have a high income year, you've sold that business, or we want to do a bunch of Roth IRA conversions or something, and you're already making charitable gifts, we may incorporate a donor advised fund into your planning to do that. What this would do, and this would be a pretty big deal, is essentially would eliminate those upfront deductions. It would say, yeah, you can put $100,000 in your donor advised fund, but you don't get to take a $100,000 deduction this year. Depending on the category of the donor advised fund, they're now going to allow you to take deduction when you make the grant to the charity. So it essentially would be the same as if you made the direct gift each year. So this would eliminate a pretty effective planning tool for people that are making large charitable gifts. And this bill is in the Senate. I would put it in the possibility category. They're looking for ways to raise revenue. This would be a way to raise revenue. So this could happen. And again, for most of you, it's probably not going to impact you. But if you are philanthropic, this is a strategy that we currently have available to us that maybe will go away. And so we would maybe want to look at, well, should we be doing more DAF planning this year while you still have the tool? Okay, so the last one for me is the Secure Act 2.0. I'll put this in the probable category because this bill is in Congress now, and like Secure 1.0, it has bipartisan support. And there's actually a lot of goodies in this one for us. So probably the biggie for most of you on this webinar is they're talking about changing the RMD, required minimum distribution age, again. Currently, it's 72. As Blake will talk about, it had been 70 and a half. Now they're talking about ultimately changing it to age 75. People are living longer, they're working longer, so they're feeling like we shouldn't have to force people to take money out of the retirement plans when they're not retired. And so what the Secure Act 2.0 says is ultimately it would go to 75, it would go to 73 in 2022, then it would go to 74 in 2029, and ultimately in 2032, so another 10 years, it would go to 75. So whether this would help you just depends on your age. If you're young enough that you wouldn't hit RMD age before 2032 anyway, you'd get the full increase. If you're hitting RMD age in the next couple of years, you'll get an extra year or so off of this. Another provision that's in there that's kind of nice is they'll increase the catch-up limit to $10,000. So in your current 401k, you have an additional catch-up contribution. They're essentially doubling it in this case. The one caveat they have in here though is you can only do that between 62 and 64. So they've given us this this like 3-year window where you can sock away up to $10,000 a year extra. That's great, and it's certainly helpful, but at those ages, it doesn't give you a lot of time to compound that and grow it. And so if we're trying to save as much as we possibly can for retirement, the earlier we can contribute, the better, because then we can use compounding. But certainly it's helpful to be able to sock away an extra $10,000 and get deferral for as long as we can keep it in there. But unfortunately, it's that 3-year window. Another one that I think is very nice is right now, if you're getting a matching contribution on your 401k, it has to go into the regular, ultimately taxable 401k. The Secure Act 2.0 would say, you can put it into your Roth 401k if you want. So the employer could put the match into the Roth 401k. That gives us more flexibility to build up money in Roth accounts, which is really important to us as tax planners. And Blake will talk about the Roth conversion strategy in a little bit. And then the last one I'm going to talk about is employers can match student loan payments with 401k contributions. So what you have right now is, if you've gotten out of college, you have your job, you want to participate in your 401k, but you got a mountain of student loan debt. So what do? Do I pay off my student loan debt, or do I put my money in my retirement plan where I can't touch it for who knows how many years? It's kind of a dilemma. And so people are paying off their student loan debt and they're missing out on matching contributions. This would allow the employer to match as a contribution to the 401k the amount that the employee is making as a student loan payment. So what are the benefits of this? Obviously, every year of additional deferral we can get on those RMDs is important to us. Now, it doesn't always make sense to just defer, because we're just kind of building up this big account that's ultimately going to get taxed, and the government's going to get 30 to 40% of your IRA or 401k. But it gives us more flexibility. That ability to allocate matches to a Roth or a regular, I think, is big, because one of the things we really like to do is have tax diversification and get as much money into a Roth as we can. The extra catch-up contributions is nice. I don't think that's going to move the needle on a lot of people's retirement funds, but it's helpful. And I think the student loan debt, being able to pay that down and receive a matching contribution by your employer, I think that one's huge for our younger clients. So there really isn't anything bad in Secure 2.0. It's all good stuff. We think this one's going to happen. Maybe it doesn't get done this year, but this is one of those things, as I mentioned earlier, Secure 1.0 took a couple years to get passed through and ultimately become law. So this one probably will happen. If it's not this year, it'll probably be next year. And so with that, I'm going to turn it over to Blake and let him talk about some of the provisions you need to know about in the existing laws and then some of the strategies that we can, still incorporate to help lower your tax bill. So Blake, I'll turn it over to you.
Yeah, thank you, Jim. I really appreciate that. So he touched upon it earlier, the Secure Act 1.0. It passed in 2019. One major provision from this was a change in the required minimum distribution age. So if you're not familiar with that, you contribute to an IRA, you get that upfront tax deduction, then the IRS comes at you, they come knocking on your door, they want their money, so they require you to take money out of your retirement accounts. It was previously 70 and a half. The Secure Act moved it to age 72, so you have a little bit more runway until you're required to take out that money. However, this didn't change the qualified charitable distribution age. That's still 70 and a half. So you technically could take a qualified charitable distribution before you need to take your required minimum distribution. But the most notable provision throughout this law was the elimination, or what we call the death of the stretch IRA. So prior to 2020, individuals that inherited an IRA from a non-spouse, so just think of like a parent, were able to stretch the required minimum distributions from the account over their life expectancy. So they were able to stretch it out, sometimes 20, 30, even 40 years. Now with the passage of this law, if you inherit an account from a non-spouse, perhaps like a parent, you have to deplete that account within 10 years. So your timeline could be a lot more finite. Next slide, please, Jim. Yeah, one more. Okay, so going back to the previous one, please. Sticking back to the qualified charitable contribution. So the qualified charitable distribution, okay. So essentially this is a way for individuals to take money out of their individual retirement accounts and send it directly to charity. So I mentioned earlier, you can start this as soon as age 70 and a half. And this really becomes a benefit to you once you reach that required minimum distribution age, because it counts, it fulfills as your RMD. It's essentially a tax neutral impact. So what does that mean? You have an RMD, you're 72 years old, you have an RMD that's calculated of $20,000. You can send that $20,000 directly to a 501c3 organization like a United Way or another type of charity, and that will count as your RMD. You don't have to report that $20,000 on your 1040, so you're just not taxed on the money. So this is a great way to not only achieve your required minimum distribution, but you also avoid that $20,000 in paying taxes, and then you're also giving it charity. So it's a win-win scenario for you overall. Just a great way to kind of help accomplish that charitable goal. Next slide, please. Okay, so going back to the stretch IRA, talked about it earlier, but now you have to deplete the inherited IRA account within 10 years. They did give us some flexibility here that you don't have to take out a certain amount each year. You don't have to take out, let's just say you have a $100,000 inherited IRA. You don't have to take out $10,000 each year. You have flexibility to take out more amounts in certain years. Don't take any in 1 year. Really, you have to take all of that money within a 10-year time frame. So this becomes really important when you are in a high tax bracket. Say you're working, it may not make sense to take out money out of that inherited IRA in that year. So I'll give you an example. Say Bob and Sue, both working high incomes, and they're going to retire in a few years. Bob just inherited an IRA from his mother. Instead of taking out that money from the inherited IRA in that year that they're working, they should delay and take out the inherited IRA money when they're in retirement, when they're in a lower tax bracket. So you have the flexibility to be meticulous into when you're going to take out that inherited IRA money. As long as it's done within 10 years, the IRS doesn't care how you do it. Some exceptions lie for qualified beneficiaries. So here I'm talking about minors, kids under the age of 18. So if you're under the age of 18, you inherit an IRA from your parent, you could stretch those required minimum distributions up until you reach the age of 18, then you get on the 10-year schedule. Another qualified beneficiary would be a spouse. So if a spouse inherited an IRA from their loved one, they could essentially take out that money over their life expectancy. And then the final qualified beneficiary would be individuals who are less than 10 years of the decedent. So let's just say you inherit an IRA from your sister or brother. Your sister or brother is a few years older than you. You can then stretch out those required minimum distributions over your life expectancies. So all this kind of sums up to make sure you review your beneficiary designations. That's something that we could help you out with. If your kids are going to be inheriting these accounts, set the expectation. If it's a large balance, they're going to have to get rid of it within a 10-year time frame. Next slide, please. Okay, so the America Rescue Plan, this was a law that got passed this year. The first key provision there was the stimulus payment. So there's 3 stimulus payments in total. The third one specifically is one that you probably received this year. How these are treated are as a recovery rebate credit on your tax return. So essentially, you get the stimulus check, and then when you file your tax return, come next April, it asks, did you receive your stimulus check? You say yes, then you don't get additional money. If you didn't, then you'd be eligible to receive that $1,400 payment. So there could be a scenario where you didn't receive a stimulus check this year, but you could receive it come tax time, April of 2022. Let's just say your income in 2020 was very high. You made more than the stimulus check qualifications and you didn't receive one, and you have a low income 2021 year, you can then receive that stimulus check as long as you meet that qualifying criteria. So there's a possibility that you could receive one if you have not already. The child tax credit, so for those that have children, they did bump this up from $2,000 to $3,600 for kids under the age of 6, and $3,000 for kids 6 to age 17. So it used to be for only those under the age of 17. Now 17-year-olds are entitled to this child tax credit. It's a fully refundable credit, which is different from previous laws. And then what's interesting about this is half of the credit can be paid in advance to you. So if you did qualify for this credit, you might have received a check on July 15th. The IRS has been sending payments. They started July 15th. They're going to send it over the next 6 months and pay this credit half in advance to those who qualify. One thing to note about this is if this does apply to you and you have income in 2021 that's more than the child tax credit income criteria, you may have to repay some of that back. So just something to be mindful of if that might apply to you, and that's something we could help analyze. Keep some cash on the side because you might have to pay the IRS back. Increased child independent care credit. So they really bumped this up for those putting their kids in daycare. It was $3,000 of expenses for one child, $6,000 expenses for two child. Now they bumped it up to $8,000 of expenses will qualify for one child, $16,000 for two or more. You can get a larger credit for putting your kids in daycare or summer camps or preschools, and this is phased out as well. One thing to note about this is if you have a flexible spending account through your employer, you can't double dip in your your benefits. So if you're putting money into a dependent care flexible spending account, you may want to think about what's a greater tax benefit to me, this new and enhanced child independent care credit or the amount that I would get from the flexible spending account. And then the final major provision in this plan was the reduction in the ObamaCare insurance premiums. So for those that are not working and don't have a health plan through their employer, or those that are not on Medicare, you possibly could get health insurance through a state exchange. Covered California is the one in California, and have your premiums be subsidized, be reduced by the federal government. They significantly increased the income thresholds as a result of this plan. So a lot more people are seeing a lower health insurance premium as a result. So something to think about, perhaps you're retired at 62 and you're not quite going to be on Medicare till 65, you need to make up that gap. You could go through an exchange called like Covered California and get your health insurance at a reduced cost. Next slide, please, Jim. Okay, so charitable giving, this was a huge win for those who are charitably inclined. Instead of previously being able to contribute 60% of your adjusted gross income to a qualified 501c3 organization, you can now contribute in 2021 up to 100% of your adjusted gross income. Your adjusted gross income is $100,000. You can give $100,000 in cash to a charity and have that be completely written off. And this has to be a cash gift. So again, kind of sticking with the same theme of a high tax year, this would make a lot of sense for those that are possibly nearing retirement in their last few income years. They want to front load all these charitable contributions and get a big charitable tax deduction write-off. And maybe that can count as their charitable contribution for the next few years. So it's a good way to kind of funnel all your charitable contributions in one year and have that count towards subsequent years. Next slide, please. So just some strategies to keep in mind for this year. We touched upon it a little bit, but Roth conversions. So everyone does a good job contributing to a 401k, and they get all this money in tax deferred accounts. Something that we always evaluate every year is how can we tactically move money from those IRAs into a Roth for future tax-free withdrawals. One key note about this is it makes sense in low income tax years because the amount that you convert from the traditional IRA to the Roth is taxed directly to you in that year. So we like to see what's the optimal amount to convert where you're not paying a whole bunch in additional taxes, you're not jeopardizing Medicare premiums or your Social Security benefits being taxable. Usually it makes sense before required minimum distribution age and after you retire. So, perhaps in your 60s up until your early 70s. Mentioned it before, but doubling up on your itemized deductions. So front loading all those charitable contributions perhaps in one year, or maybe if you have a surgery and you want to do that in the same year that you're making a large charitable contribution, again, taking advantage of your itemized deductions. Tax loss harvesting. So this is using capital losses to offset capital gains. So possibly there's a downturn in the market, and this is something that we do for our clients. We take advantage of those losses with the expectation that we would use them against future capital gains or use them against your ordinary income. So really being meticulous with those capital losses. And then tax location. So being intentional with the types of investments to hold in certain types of accounts. So an example of this would be holding bonds in an IRA because we would like lower required minimum distributions, and then putting stocks in a taxable account, more tax preferential compared to an IRA. So this is the type of tax location strategies that we implement. Charitable strategies, we talked about them before, but the donor advised funds, the qualified charitable contributions, the donation of appreciated securities. There's a bunch of charitable contributions, or the front loading the charitable contributions. And then the tax diversification. So this is essentially making sure you have a tax deferred account like an IRA, a taxable account like a trust or an individual account, and a Roth. And being really thought-provoking as to how can we create the lowest income tax impact when you need portfolio income. Should we take $5,000 from the Roth? Should we take $10,000 from the individual account? Should we take $3,000 from the IRA? How can we blend these different types of accounts for the most optimal tax outcome for your financial plan? You can go on the next slide, please. So how can we help? I know we work with a lot of you already, but tax planning is our specialty, something that we will continue to hone on more and more. Jim is an enrolled agent, so he can represent you in front of the IRS. I know we do a lot of your tax returns, but come 2021 tax season, that's something that we'd be happy to do as well. Have a conversation if you'd like for us to do your tax return. But that's something that we'd really incorporate in addition to our investment management and other financial planning areas is how could we add alpha in the tax side of things. And then acting as a fiduciary always 100% of the time. That's kind of our motto. So we'll check the chat box here to see if there's any questions. I know we're right on the dot of 7.
We are. We've got a couple questions here. So one is, my wife's brother passed in 2006 an inherited IRA. Is that grandfathered? The answer is yes. So that was prior to the Secure Act. So when your wife's brother passed away, your wife had to start required minimum distributions based on her life expectancy at that time, and she would continue to use the same table and the same process. That one is, your grandfather and the old rules, so you could stretch it out over life expectancy. Next question, while cryptocurrency is still pretty volatile, do you foresee any circumstances where this could be a hedge against inflation and taxes? Very timely question. I just wrote a blog posting yesterday on kind of our take on Bitcoin, cryptocurrency, marijuana stocks, NFTs, all of that stuff. So go to our website and read the article, and we'll you can get our take on it. At this point, we feel that it's still highly speculative. It's kind of the analogy I used in the article is, if a lot of things are the Wild West because they're not that regulated, cryptocurrency hasn't even made it to the Wild West yet. It's still Lewis and Clark. It's very uncharted territory. And then finally, go ahead, Blake.
I was just going to say, I'll add to that a little bit. It's something that we're staying on top of. So we're evaluating it, and we're definitely well aware of new types of cryptocurrency and the coins and the legislation that's being put forth by cryptocurrency. So we're on top of it. It's something that we'll continue to discuss with our investment team and see if it makes sense to implement for our clients. But we're at the research stage right now. It's in its infancy in itself. So we really want to make sure we do all of our checks and balances, again, before we put any clients in a speculative investment.
Yeah, and then the last question we have, unless anyone else wants to ask some more, is, do any of these proposed laws address how the Social Security COLA is calculated? And the answer to that is no. There's been talk about changing the index that's used, et cetera. Not currently in any of the bills that we've talked about. And at this point, as an FYI, it's looking like we're finally going to have a fairly hefty Social Security COLA increase. It could potentially be as high as 6%. They actually released the numbers in October, but a lot of people are speculating that it will be a pretty hefty COLA increase this year. Looks like maybe we have another question. No. Oh, nope, I don't see anything else. So at this point, like Blake said, we're like right on the dot. If you do have other questions, don't hesitate. Shoot Blake or myself an email, give us a call. If you want to have a consultation about your individual situation, certainly reach out and we'll get that on the calendar and take care of you. And then mark your calendars for the next one.
There was one more question. There was a mention about spouse taking over an inherited IRA. This is only if the inheriting spouse dies, correct? So essentially, if you're married and you inherit an IRA from your spouse, you have 4 options. You could assume it into your own IRA. You can create an inherited IRA. You can essentially take the money out, or you can, essentially take the withdrawals there. So you have a more flexibility as a spouse compared to a non-spouse when it comes to inherited IRA distribution.
Yeah, and generally that's why we advise that if you're married, your spouse is the primary beneficiary, because that gives us that flexibility. Think about a situation where maybe that surviving spouse is under 59 and a half. So if we roll that to that surviving spouse's IRA, there's no tax consequences, but now it's subject to the 59 and a half penalty, where if we leave it in the name of the deceased person, essentially that inherited IRA, now they can pull money out without the 10% penalty for being under 59 and a half, because we have an exception for death. So it's really important to have the spouse as the beneficiary, and then we can come up with the right solution at the time of death.
And then just a reminder, so a survey will go out at the end of this webinar, right when we sign off here. We really appreciate your feedback. If there's anything we could do to improve these webinars in the future, or if you have any topics you'd like to hear from us about, please fill out the survey, check the box. And just expectations wise, we'll try to get out the recording on Friday. If it doesn't go out on Friday, then definitely early next week, we'll get you out that recording. And stay tuned for our next event, the Social Security webinar on September 15th